where people are slowly coming back after their lunch. I'm here to talk about regulatory challenges and opportunities in fintech. And one of the things, thank you very much. One of the things I was quite surprised about earlier, and no disrespect to any of the speakers, was the negative capacity I'm hearing fintech or regulatory issues spoken about in. And I think it's important that we start with the fact that regulation is not a bad word. Regulation is there for two reasons. One, for prudential standards, to make sure there's not a collapse of an entity which could have a domino effect, not just locally, but around the globe. But secondly, to ensure that we have the right conduct. And those are the two underlying drivers to regulation. Regulation as well is not a plaster to cover all wounds. Regulations will be built on principles, and those principles then need to be applied and incorporated. Because there are challenges in KYC, and one of the things I was speaking about over lunch, it's not a challenge because of the regulation, it rather is a challenge because of how the rules have been implemented at the relevant organisations. Also, there's geopolitical issues to consider, well, mostly, should I say, geographical issues. If we look at individual onboarding, for example, from a KYC perspective, you can open a bank account in Singapore in 2 minutes. Why? Because you have a central database within the country where everybody's credit profiles are contained. Once you've linked up your KYC tool to that central database, you have everything you need for KYC purposes to open an account. That's great. But for example, in the UK, that doesn't exist. So what happens in the UK? Everything has to be provided as and when it needs to be requested for account opening purposes. So what you have to remember is, whilst regulation is not there to stifle or prevent innovation, sometimes the challenges within the regulation are because of issues that are outside the capacity of the regulator. And sometimes they can also be the fault of the firms themselves for the way in which they have implemented the rules. We've also found a lot of tech firms, in particular crypto firms, have been employing people from traditional banking compliance. Now, that's not a bad thing. I've been in the industry over 20 plus years. My background is in traditional banking. I've also worked in crypto firms. But what you have to remember is you're going into a firm that has been built from a tech perspective. You're then potentially implementing manual processes where, in fact, you should be thinking innovatively and outside of the box as how to automate and how to use the tech infrastructure to automate the processes. And unfortunately, that's not happening. So we're seeing a square peg round hole situation where you have these innovative tech firms that suddenly have back office systems that are 30 years old because they've been built on manual processes. And you should be looking optimally between a 70 to 80% automation in your compliance framework. So when we speak about regulation, and earlier when I heard the panel talking about the challenges and regulatory challenges, yes, of course there are challenges. But what's really exciting about in the market at the moment is, I've been in the industry since just post-Enron. I trained as a lawyer at the European Central Bank. I've lived all over the world, Singapore, London, Hong Kong, Frankfurt. I have seen all of the various regulatory environments and worked with most of the regulators around the globe. But one of the things that I'm so excited about at this moment in time, if I can just say, is we're bringing sexy back in the products that are in the market. Because after 2007, 2008, I'll be honest, our products got pretty sterile because of the risks involved. CDOs was a great example. People really understood how these products were being packaged. We're now at a cusp of a new frontier within banking and how we provide banking, which means that the regulators also need to upskill and learn. And a really good example here is 2015, I was at a closed-door meeting with the MAS in Singapore, and they were very clear, we don't regulate in the crypto space, exchanges, etc., because it's not recognised it's basically as a payment method. In 2019, an internal memo, internal document within the Securities Exchange Commission in Singapore was thrown in the bin, which basically opted for them to regulate the exchanges because they said, again, we don't regulate this space. Fast forward 2 years later, guess what? They regulate that space. So we're currently working in an environment where the speed of the landscape and the products that are being provided in the landscape is happening quicker than what the regulators are able to upskill and educate themselves on. So what's critical here is the importance of public-private partnerships. You, in this room, working with regulators to understand what their expectations are, and so we can then talk to them about how the products are developing so they have comfort, so that we can work towards a kind of a common goal, which is protecting both the prudential standards and the conduct standards within the market, because that is our honest goal. You know, areas of regulation within fintech are quite broad. Cryptocurrency, open banking, which we'll speak about later today, blockchain, insurtech. Blockchain is fantastic in terms of its use case. In KYC, we saw Singapore, for example, implementing blockchain technology for trade finance purposes, doing away with physical paper, if anybody who's involved in trade finance would know. It's a very manual system, which during COVID showed us a lot of the challenges we have. So there are use cases for the technology, the blockchain technology within compliance as well, which is really important. But the regulators as well need to be educated. So what is our challenges? 4 key challenges that we're experiencing are the complexity of the regulatory landscapes, compliance costs, consumer protection, and of course, lack of regulatory clarity. Why complex regulatory landscape? Because there isn't one global regulator. As many of you have mentioned, we have various regulators around the globe. Some operate in a unified perspective, i.e. it's one regulator for everything. Take, for example, Singapore, the MAS. Or you could have a 2-tier system where you have one regulator, in inverted commas, for prudential standards and one for conduct. UK is a great example between the Bank of England and the FCA. And then you have others, ones where it's actually diversified by product. Hong Kong, the US are good examples. So you have to understand that different countries regulate in different ways. And that causes challenges. The crypto space is a great example of this. We have had a lot of challenges globally trying to find uniform ways in which we can move forward with certain concepts. Travel rule is probably the best one that we've unified the approach because of FATF standards. But it is a complex regulatory environment, not one size fits all, and different political agendas are also at play here in terms of protectionism. So that's one thing to be conscious of. It's not about trying to make people's lives more difficult, it's the fact that it is a very complex area that we're working in. Compliance costs. I get this quite often from firms who have said, for example, new crypto firms in the market, when the likes of Binance started out, or Coinbase, they didn't have to do KYC. But since then, the regulatory requirements have come in play, and now they're being required to do that. That's fair. That's a true statement, because the regulatory environment changed. So, new crypto firms coming into the market are saying, well, we're being faced with costs that these other firms weren't subjected to when they entered the market. That is obviously something to be considered of whenever you're setting up your business. The cost of compliance, there will always be a cost in compliance, but how you implement your controls will dictate your future costs in compliance. Compliance can destroy your business in terms of cost. I'll be honest with you, you can bleed money if it's done badly. Done badly in terms of understanding your regulatory landscape, done badly in terms of training of your team, but also done badly if it's actually not operationalized in the most pragmatic and the most automated way, which I mentioned earlier. So you need to look at how you can use technology, and in particular, we talked about AI technology, how you can use technology in that space to help you to do various things, whether it's training, building controls, or automating your processes. In some instances, people kind of confuse automation and AI, and you shouldn't confuse the two, they're very different. But do look at how you can streamline. Also, as well, importantly, one of the things we see a lot of time is silo compliance approaches, where you will have operational risk, you will have credit risk, you'll have market risk, you will have your compliance risk. Look at ways to holistically create a GRC framework, a governance risk and compliance framework. That will save you a lot of money, and there's a lot of natural synergies. Remember, a change in your client profile doesn't necessarily identify a risk. It can identify a cross-selling opportunity for you to basically work with your client during their lifetime to offer new products. I'm going quite quickly because I had a very short window, guys, so it's too fast, just let me know. Consumer protection obviously is at the forefront of everything that we do. We're probably going to find in this space moving forward that the biggest focus from a regulatory perspective will be investor protection. And this is really what we're just trying to achieve. In my opinion, the best thing, obviously you've got cybersecurity we spoke about earlier, data privacy rules, but what I think is really important in consumer protection is also education programs. I mentioned Binance and Coinbase earlier, 2 examples of crypto firms that do this really, really well. They have educational platforms within their tools to educate investors. We need more consumer protection in that way as well. We need better education for our investors. Lack of clarity of the regulatory landscape. As I mentioned, innovation is happening all around us. This is an incredible time to be, for example, from my perspective, to be in regulation, to be in compliance. Everything is changing around us. How we think about banking is changing. How we operate, gone are the high street stores. Now everything is digital. So it's really important that we understand that we're working here together with the regulator. Okay, so opportunities. We'll talk about sandboxes, that was mentioned earlier as well. What's that weird noise? It's a trolley. Thought someone was sleeping. Maybe surprised. Collaboration with regulators, global standards, and then innovation regulations. This is something, by the way, if you look globally and specifically to the crypto space and fintech space, the 3 key regulators you're looking at are in Paris, UAE, and Singapore. By far, they're setting this out. Paris is more on the ICO side, the initial coin offering, but if UAE and Singapore are offering the best opportunities to fintech firms at this moment in time. In fact, I don't believe that there's anywhere that's doing it better. You are in an amazing position to be based here in Dubai to develop your business because of that. As I mentioned, there are sandboxes where we can take the products and we can test to see how it actually works so that we're not exposing the financial system to risk. This has been done in Singapore for many, many years. It's been done here as well. It's just incredible what's happening here at the moment, and this is actually going to put the UAE at the forefront globally in the fintech space. Collaboration with regulators is of paramount importance. They need to understand the technology, they need to understand how that works in order for it to help guide them in terms of rule creation and supporting both the conduct, investor protection and prudential standards. So do partake in public-private partnerships. It mightn't sound like the most exciting thing to you, but through that you can help mould regulatory change. And then last but not least, global standards. I've mentioned FATF, the Financial Action Task Force. They brought out standards in respect of, for example, the travel rule for basically reporting standards. We need to see a lot more of this, especially in global digital assets. Crypto, I really believe the way in which we're regulating it will need to change away from the siloed country approach to a more global approach so it can be standardized. How that looks and feels, we don't yet know, but it will look very different from what we see today. And again, innovation-friendly regulations. We need regulation, but we don't need regulation that stifles innovation. We need regulation that supports innovation and supports players in the markets, gives them the ability to create new products and doesn't prevent them from coming to market. So in summary, there's a lot of regulatory challenges, of course, because we are in the midst of a transformation in how we bank globally, how financial assets and products are provided to consumers. But with that, it fosters an absolute opportunity for innovation. So as I mentioned before the break, I felt like there was a lot of negativity around regulation. What we need to do is look at ways that we can better support regulators so that they can better develop regulation that's fit and has the purpose for the products and services that we're looking to offer, not just today, but also tomorrow. So that's the end of that. So any questions? Oh.
Hello, I'm Vladimir. It was really interesting. Thank you very much for the pitch. My easy question is how we can make easier the entrance for the new startups in the market in the way that all these KYC procedures, emails, are really expensive for them, because if, for example, it's kind of social network or any other big platform where a lot of users could be joined, in average, I guess it will be somewhere, okay, I don't know, between $3 to $8 per person. If it's required some kind of KYC, it's even before email processes. How these guys could reduce these costs? Perhaps you have some advice, or some procedures or programs somewhere, how it could help them, because for example, we provide them all kind of implementation, the go-to-market strategies, all this stuff, and it will be really interesting if we can find some answers for them with you. Thank you.
I think the first thing is, the answer will really depend on the type of clients you're dealing with, first and foremost. Will it be retail customers, individuals, or corporate entities? Because there are different challenges embedded within those. What we're seeing a lot of startups, of fintechs do, is use third-party tools that provide a lot of these services already, and there are many of them around the globe. I could provide you with a list of 20 or 30 of them you could go through. So that's the first thing. It's don't try and reinvent the wheel here. Use what's existing in the market. As I mentioned, there will be a cost, but that comes with the regulatory environment. So for individuals, I've mentioned it's straightforward enough. For corporate entities, it's challenging. If you're going to be just onshore, it'll be a different risk exposure than if you actually have clients that are corporate entities from overseas. Because some countries, there are challenges in obtaining corporate documentation, or indeed how it's captured. A great example here is, in the UK, you have a central company's house, so you can always refer to company's house by the number to find details, etc., for your due diligence. In Indonesia, it's actually done by state, and they don't necessarily speak to each other. So you have two very, very different parameters. There's a lot of work being done on unique identifiers to see whether or not globally we can create standards for corporate entities. But kind of KYB, know your business, for your corporate entity, is a very challenging space. So to answer your question quickly, there are third-party providers that you should leverage off as a small startup. I would definitely recommend that. I wouldn't look to building an in-house capacity to support this until you're much further down the line. And even then, you have to understand, is it worth the investment to build it yourself or to leverage off external technology? But one of the biggest things I would say is automate as much as possible from the very beginning.
Thank you very much. But I have a small second question, if no one have nothing against. But the question is about, perhaps there is some services or aggregators where all this KYC data is already collected, and for example, the clients from this KYC provider, by using other third-party products, I don't know, exchanges, doesn't matter, any kind of, the projects where they use, for example, MetaMask or kind of, Web3 wallet, they could, with kind of token, just, identify themselves and just, transcend data without the need from the client side, I mean, like our B2B clients, to require this KYC procedure back again. Yeah, thank you.
That would be ideal. So the quick answer is that would be great. We are restricted in terms of data privacy. If clients provide their information to a centralized database for that usage, it would have to be, there are certain sign-offs that they would have to provide for that information to be transmitted, etc. There is definitely work underway to try and look at ways in which we can better utilize the tools. And in fact, there's a lady in the room here, Nicola, who is an expert in this area. But at the moment, the challenge is data protection rules, people basically given authority for this to be transmitted. Who will own the data? Where will it sit? How can it be transmitted, etc.? There's a lot of legal issues embedded within it. Pardon? It's not that easy to do it country to country because of restrictions in data, data privacy. But the data protection rules are the new ones, especially that were rolled out a few years ago. They were, especially in the UK, they had international reach, and they are very, very laborious. So it was actually more stringent than the previous Swiss privacy rules. So it does create challenges. But these are definitely issues which constantly we're trying to rectify in the industry, but it's not something we found a solution for yet.
Hi, Salwa from TradeFinex. I had a question because actually we work on blockchain, and this is a question that comes often, the data. Yeah. Where is it stored? So it's hash, and it's a distributed ledger. How do you think this could be with all of these new rules, and how can this work together?
It's a good question. I think Singapore, maybe if we go back to the trade finance example, it worked really well onshore. It worked really well in country, where it was basically an experiment between, I think, 11 banks altogether. So they came up with using the technology to transmit the data. The challenge was them moving it offshore. So they could use the technology in country, but the challenges were like, what can we do to go cross-border with this? That's
exactly what we do. We are running some pilots, and one of our customers wants to do the pilot with us is based in Morocco, for instance, yeah. And the government and the structures behind it, like, okay, but where is going to be the data? Yeah. And since it's blockchain, we've explained, how it works, but since it's there is not a strict
I understand what you're saying. Yeah.
framework around it. It's a complicated issue. Yeah.
Yeah. No, I don't have an answer for you. That's true. That's why the Singapore example wouldn't work globally because of that challenge. Sorry, Nicola. Yeah.
Just to add to that, I think banks, when they're trying to share information across their own internal organisations, they have to get their clients to sign up to terms and conditions around data sharing. So even where it relates to the blockchain scenarios, your client has to give you permission. So if they are allowing you to share information outside of a country, a tool with others, it's down to that contract that you have with them. And that's how banks operate today. They make sure that in their terms and conditions, they have the ability to share information where it relates to AML, where it relates to regulatory requirement with their organisation globally. So I think some of that is about your relationship to client, your contract with client. The things that we find difficult is clients don't want to sign up to a broad scope contract that allows you to share that information. So it's a bit like the whole KYC utility history that we went through. When you're trying to create a utility or a sharing platform, there's always that red tape around privacy, and Una has said that a number of times today. It is that contractual sharing of information that we all stumble over.
And the challenges as well is kind of geographical exposure, which some clients don't want as well. And, the minute that you touch, for example, US dollars, OFAC sanction regime will automatically apply to your client. So you need to think carefully about sanction applications of rules as well. So what services are you providing, what denomination, what currency are you using, where do the clients want their data stored? Like, for example, it's KYC utilities. Some of them will have a server based in, for example, Germany. Another one will have a server based like in LATAM. And you can actually dictate where you want your data stored so that it doesn't get to move offshore. So these are some of the things that we're trying to work with in the background. But as Nicola said, no clients really want to sign a general disclaimer that data can be shared worldwide. It could be for many reasons. It could be for tax reasons. It could be for a multitude of reasons. But these are hurdles we're all going to face going forward. And unfortunately, I don't have a black and white answer for you.
Blockchain is not in one place.
No, it's not. It's universal. Yeah, exactly. It's floating around.
And maybe small comments in context of European regulation, and even, for example, as mentioned, client give that consent to go outside the European Union, still you can't do it because you need to ensure that, for example, even in the United States, where there's quite high standard of data protection, data will be stored at least on the same standard as under GDPR. And if you can't ensure you can't give that data outside European Union. And for example, okay, a few months ago, European Commission adopt that additional decision with list of particular companies which comply, such as Amazon, Google, and etc. But if we talk about small, client, like business-to-business solution, you can't do it because you can't just transfer that data. You need to ensure that your service provider have some kind of services inside European Union, and it makes so complicated from an operational side just to get that fully automated solutions in fintech companies. I'm from investment company, and of course we need to buy US shares, and it's so complicated. Of course it's possible, but it takes a lot of time and of course operational costs.
Yeah. There are some, for example, if you're onboarding a financial institution, we have currently we use a thing called Bankers Alamac. I always say the name wrong, so excuse me if it's completely wrong, but it actually already has all of the KYC information on the various banks stored within it. So you don't need to go out and gather that information. Like, remember how many kind of authorized signatories, etc., these banks are going to have. So you do your due diligence based on the information provided by Bankers Alamac, and that's great. That works for financial institutions, but outside of that, we really do struggle as an industry. There is a firm actually called Know Your Customer, based out of Hong Kong, and they're doing a lot of work on this in the corporate space. It's really good what they're trying to. They're trying to create a corporate utility where customers are willing to share data and share information, etc. And we're looking to that at the moment to see whether it's going to make a difference to the market.
So just to add on to this data privacy issue, we actually delivered recently one digital currency project in Middle East itself. So right now the preference is, so for example, when we discuss stable coins, this debate comes into picture that whether it will be a public ledger like Ethereum or some other blockchain. But banks usually prefer, more centralized version of blockchain, which is basically either Hyperledger, or maybe it is Ripple, or maybe it is Corda. So there they actually prefer to follow you the standards that are already in practice for the last 2 to 3 years. They don't want you to do something new. And as rightly was pointed out, that the issues like denomination and everything. Mm-hmm. So they are already figuring out that how to find a centralized version of an NFT or something like that, where actually these digital copies can be then made. But strictly speaking, the data has to be within the boundaries of the country at the moment. And we all will have to kind of, comply with what is the standard right now among the banks actually, not just one bank. Because if one bank changes the infrastructure, the other banks are forced to do that. So the scope right now is strictly the more centralized version of blockchains. So for example, Ripple and Hyperledger, they are mostly in the demand right now, and they already have that sandbox where they can handle these issues, GDPR.
We are actually ISO 222 compliant, and we work with R3 and Corda. So we are on the right prospect with XDC network. I think the question is more the data from when a customer, like let's say, submit a bill of lading, he's creating a document online. The question is like, okay, where is this information stored? And this is where, because it's distributed, and it could be partly NFT, partly hash. So I think there is still a regulatory or something to be developed to make sure that everyone is compliant, and at the same time everyone has an answer to the who owns the data, where is it, and so on.
Still initial stages, yes.
But if it helps, I can connect you with some people that are working on global projects for this. So just reach out to me, and I'll connect you with various people. There's a lot of projects underway in this regard.
Okay.
So let me put you in touch with the various people.
Thank you.
Do we have time for one question?
Yes, certainly.
So when it comes to CBDCs right now.
Oh, sorry, I thought the gentleman behind you was asking the question.
I'm a bit short when it comes to height. It's fine.
And I was like, how's he doing this? It's like a ventriloquist.
Stable coins versus CBDC. I mean, this is again the same issue that she's addressing. So when it comes to stable coins and CBDCs, right now it is definitely a competition.
Yeah.
I mean, Circle and others, they're trying to kind of take the narrative of decentralized finance ahead, while CBDC central bank want to compete with it for a more private or secure version of it, right?
Yeah.
How do you see this playing out in, let's say, next 5 years? I mean, do you see a collaboration within these two industries, or do you see kind of CBDCs overpassing or stable coins and kind of overpassing the CBDCs?
Let's be just black and white. What is a CBDC? It's basically a digital version of existing currency. So, you've got the digitalized yen, potentially we'll have the digitalized euro at some point in time, where we still haven't ironed out what is going to be the role of traditional banks in the new digital world and the rollout. So that's in Europe, that's one of the biggest stagnant points at the moment, because that needs to be ironed out. So I think you just need to look at it very plainly. We've got fiat currency today, which will translate into a digital form. It's not going to change. How we obviously transmit money and use money will no longer be physical, it'll be digital, but it'll still be the currency that we use today, but just in another form. You're asking me, will CBDC and stablecoins be looked at in the same way? Well, no, because a stable coin isn't going to be tracked or indexed the same way in which a fiat currency, a digital fiat currency would be. So in my opinion, they will be separate and they will be a distinct difference because of that. And I don't think that we'll ever be in a space where stable coins, potentially Bitcoin might be the one, and maybe ETH, that they may be the two that we can actually put in the same category as similar, but no, they will be very distinct from one another, purely because one is a government-ran program, which is the operating currency of your country, and the other is a decentralized form of payment.
What about cross-border retail payments?
Goodness me, you're putting me on the spot today. I don't have an answer for everything.
Thank you.
Do you think the ISO and Basel Committee are doing enough in terms of ensuring a level playing field for all stakeholders in the fintech space?
Is it a level playing field? Well, I mentioned already that we have strong people in the market who potentially have monopolies already because they entered at a very early stage and they've managed to gather a lot of the client base already up. So the market isn't a level playing field. Is there barriers to entry? We've talked about the cost of compliance. There are costs associated. To get a regulatory approval, for example, in the UK, a crypto license, you're probably looking around an investment of £1.2 million. I'll be honest with you, if you want an exchange license. That's what the investment will be just to get your license, not to mention all the staff around it. So the playing field itself isn't level to start with. I don't think that we can look to Basel and ISO in terms of them not creating a level playing field. I think the market itself is already unlevel. FATF are trying to make measures to bring consistency globally. So yes, they're trying to level out the standards. How those standards are implemented at a country level will dictate how the playing field plays out in the longer term. I don't know if that answers your question. No.
To some extent you have.
You can say no.
I have a concern because there's some countries out there, you find a brilliant innovation is being offered. Mm-hmm. But just because the central bank doesn't subscribe to crypto, they shut it down, they impose anti-money laundering laws on them, the investors lose out their money. I believe that is not nice.
Well, this is where people are going to vote with their feet. This is where people are going to move to an environment such as the UAE, where they are supported in the development, and that's the advantage that the UAE will bring going forward. This will become the digital center of the globe. In my opinion, if it continues on the trajectory it's on at the moment. So people will vote for their feet to move to jurisdictions where they are supported in their entirety for the development of the products and services, which will only bring advantages to the country that's supporting them as well. But yes, in the initial stages, when they're in a country and they've already lost money, it's difficult. Any other questions? No? Okay. Thank you very much, everyone. Yes.
Thank you so much. Now let's move to the next session, session 5, blockchain and cryptocurrency in fintech. For that, our moderator is Unuk van den Berg, Chief Executive Officer, Virtual Risk Solution, Portugal. And the panelists are Khesem Leh, Co-founder and Chief Executive Officer, Bright Wealth Banking Consultant and Management Consulting from UAE. Sunil Sharma, Founder, Coinage UAE. Arvind Kasme, globally recognized NFT marketing expert, Sold Out NFT UAE.